Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
It's definitely not Phil today. It is Katarina Taurian, and I'm the head of editorial here at Smart Property Investment. I'm so pleased that you could join me. I'm here today with Simon Peisley and Cameron Black from Certainty Property. We were recently trotting around on our high horses over a coffee and decided it's time we jumped in front of the microphone. Welcome, Cameron and Simon.
Thank you.
Now, one of the things that we were absolutely going mad about recently is vacancy rates in Sydney, especially you and I, Cameron. Why don't you tell us what it was that was getting us both going?
Yeah, most definitely. So I think one of the things that we're having a chat about there in terms of vacancy is the fact that it's often a bigger cost to property investment than what a lot of people realise, and also the different lengths of time that a property can ultimately remain vacant. So a lot of people don't realise that in Sydney that's around 32 days. And
ouch.
Yeah, it's a long time without rent. And that it can vary quite a lot on a suburb by suburb basis as well. Quite often there's a big issue, especially if you bought, for example, off the plan and there's a lot of apartments all coming online at the same time. That can stretch up to 2 months in some instances. So, yeah.
Is it the off-the-plan ones that are being hit the hardest?
Yeah, I think so. So I think the main thing really is looking at a suburb-by-suburb basis, and if there are a lot of apartments that are coming off the plan all at once, you know, that can definitely have an impact. And I think also when you look at the dynamics of actually renting out an apartment, if you have a whole lot of apartments, say, settling all on the same day and they look more or less identical, everyone's competing for the same tenant pool. And I think that's something that you have to keep in mind when you're purchasing an investment property. Yeah,
that really hurts. Are there any places, we're talking about Sydney specifically here, right? That's
yes.
where you specialise?
Yeah, so we specialise in Sydney. Generally speaking, it's a lot of the suburbs that, you know, the further out west that you go away from the CBD, that's where you tend to see some of these higher sort of vacancy rates and time on market. But interesting, I mean, the Sydney CBD has got a vacancy rate of around 8%, which is triple the average for nationally. So it's
that's outrageous.
Yeah, it's quite a lot. So just because you're right in the city, it doesn't mean that you necessarily escape that problem.
Yeah, you're smiling loads over there, Simon. Tell us a bit about the time frame that this started to become a real issue, a crippling issue in Sydney.
I think the best way to look at it is if you can see a crane outside, then you can sort of see it's going to be an issue or has begun to be an issue. Over the last 3 years, Sydney's had one of the highest crane indexes globally.
Is that a thing?
That's a thing.
Okay.
That's a thing. Yeah, that's
okay.
a thing. We have more cranes here than New York.
Goodness.
In the air. So what does that tell you? Well, it tells you that a lot of buildings are being completed now, a lot of stock coming up. Why is it such an issue? Well, I think regulation, we know that. We know that developers are a lot easier to build, and we've seen that occur, and now it's coming to fruition. I think we've got, 56,000 new apartments coming online in the next 6 months in Sydney.
My goodness.
So that's just going to add to the stock that's already out there.
That's huge. Look, seeing cranes is a good thing as well because it means there's infrastructure development, right? It means that money is being spent on the kind of things that make people want to be in an area. Like, you know, there's more space for people to be there. So then in your experience, where is a good buy? You know, if cranes are dangerous but cranes are good, where do you buy?
I think you look at, well, two things. Firstly, do you buy off the plan or do you buy something that's existing? Now, that's a double-edged sword. You look for where there is infrastructure or potential infrastructure and green space.
Green space.
So are there parks? Are there likely to be parks? Are there swimming pools? Are there all those amenity that you'd expect? And that doesn't necessarily mean in that development, but maybe around that area. You know, I know I've got two little ones, and when we look for places, what do we look for? Where can we go on the weekend? What parks can we have? Is it in walking distance? Which I think is, for me, a bit of a lay-down misere.
Yeah, okay. That's your experience too, Cameron?
Yeah, I think so. And I think in terms of looking at where to buy, I guess there are two aspects to it. A lot of people typically think just about the capital gain aspect of owning a property, whereas there's also the flip side to that, which is the potential income potential and the likelihood or the ability of you being able to achieve significant cash flow. And quite often they can be two very different things. I mean, I'm sure you're familiar with the properties that, say, are in mining towns and they have a 13% rental yield, but yet they will achieve no capital growth.
They go backwards, if anything.
They go backwards.
Yeah.
Whereas there are plenty of other properties that have a rental yield of 2%, but, they've been increasing at 15, 20%. So it really depends on your investor preference as well.
Yeah. What do you think the outlook is for capital growth as well? We've had just particularly in Sydney, such a significant change in the dynamic of the market, like vacancy rates, as we just spoke about. So is the capital growth there, or is it more about cash flow from where you're sitting?
So I think it's definitely changed. So prior to 2017, I think that there was a widespread belief that capital growth was more or less assured in a lot of these major cities. And we've seen the last 18 months where you've had price falls of, sort of 15% in some of these major cities. I think longer term, you do continue to see price growth, capital growth, but that it's probably not going to be how it was in the decade prior. And I think even from a lending perspective, which we've had lots of conversations about, I think banks are going to definitely be focusing more on a borrower's ability to service the loan. And a big part of that is the cash flow that's going to be generated from the property as well.
Yeah. Okay. Before I get on my high horse about banks, we're just going to go to a quick break. Thanks. Welcome back. All right. High horses are out. Now, I do a lot of reporting on smart property investment about loan serviceability, about the banks sort of tightening the purse strings in terms of the investors that they take on board and the ones that they don't. The data definitely suggests that lenders, not just banks, just Australian lenders, are getting a lot harsher and a lot more forensic in terms of how they assess an applicant for a loan. Is that your experience on the ground, Simon?
Yeah, it's harsher, but is it not unreasonable? I think we use the HEM model here for many, many years. It was probably a little bit too loose. The banks have obviously gone very hard one way, or all lenders went very hard the other way, and now that's coming back more toward the centre. Is it going to go as loose as it was, 2011, 2012? It's been super loose. There's been capital floating across the globe probably since post-GFC when the US were printing money and still are. And we've now have a central bank that has made it abundantly clear that they will keep cutting rates. But if you take a look at the serviceability component, it's not so much about what the interest rate is now, the headline interest rate. It's about what income are you bringing in the door and what are your actual expenses. And I've seen some commentary saying, well, this month I had to buy a present for Johnny, and that doesn't happen every month. But it does happen once every 12. So over the year, it still happens every year it comes around.
Cameron?
I'm in agreement with Simon that it's ultimately a good thing that banks are scrutinising expenses a little bit more carefully. I think that in Australia we come from an environment where we've had unprecedented growth in property prices over the last 30 years, and property's been quite a consistent way to wealth, and it probably will remain for a lot of people. But people tend not to think about the flip side, which is that if you have 10 properties and you have an inability to service that loan for whatever reason that you went, that's a very difficult conversation to have with a bank.
It is.
So I think it's ultimately a good thing that banks are looking a little bit more carefully. And it's interesting, if you look at documentaries about the financial crisis, you look back and everyone says how irresponsible the banks were. And then we tend to get a little bit funny when banks are also a bit more responsible because of the impact that it can temporarily have on asset prices. So I think it's important to have that perspective as well.
What are they watching? Are they seeing how many purchases I make on ASOS? Like, seriously?
Probably, yes. Yeah.
That's what I'm being told by mortgage brokers, and I sort of think, is that just a headline, or is that actually true?
It's a true thing, because previously banks have looked at things
upsetting.
to say, but you're suggesting you should be shopping off Next.
Yeah, definitely, 100%. Less Uber Eats, I think.
Yeah. But all the data's there. It can be tracked. And it's difficult for a bank to stand there now, post-Royal Commission, hand on heart, and say, we didn't know. And if you're in their shoes and you're a director and you're going to get prosecuted, what are you going to do? You don't have a choice. But that said, you want that certainty yourself to say, well, I'm actually going to spend slightly less because I want to buy my property, or I'm going to look at a property and unwind some of the expected capital growth and look for something that has a slightly better yield. So maybe instead of buying a 2-bedroom apartment, you buy a 1-bedroom apartment because it yields better. So can it stand on its own in terms of cash flow?
That's a great conversation to start. So never mind my ASOS purchases, which probably need to be reined in anyway. With these a more responsible lending approach from the banks, which is definitely something that SPI supports, then there's obviously a knock-on effect for the kind of properties that you need to consider and the kind of properties that the bank will be comfortable lending to. What I'm also wondering, though, is now, 2019 and onwards, how does the bank feel about an investor that's got multiple properties, Cameron? Like, what if they're sort of leveraged to the eyeballs? I feel like 5 years ago, it wouldn't have been too hard to just get some equity, keep going. Is that still the same?
I don't think so.
Okay.
To an extent. I think it's a different conversation when you start getting to investment property number 5 or investment property number 10. So if you're looking to, if you've got a portfolio and you've acquired 1 property or 2 investment properties, I think you find that a bank looks at you and says, okay, this is a suitable risk. I think it's when you start getting to 8, 10, 12, 15, 20 properties that a bank starts saying, hold on, well, this is only supported by an income of 60 or 70 or 100,000 or whatever that income is. And they have to look and say, well, what happens if that income disappears? And
fair question.
Yeah. And we've had unemployment in Australia, which is around now 6.5%, 6%, thereabouts. If you had unemployment move up to, say, 8%, people often think about unemployment about if I was unemployed, but there are knock-on effects to that. It means you can't ask your boss for a pay rise because there's a whole lot of people that will happily take your job and do it for a lower rate. So I think banks have to consider what the wider economic climate is. The other thing that I think is also worth considering in terms of banks and their lending criteria is that it can change depending on the economic environment. So prior to, if you go back to 2017, it seems like an age ago when APRA was saying you can't have more than 10% loan book growth on investment property. It was only 18 months ago. And then prior to the election, you had the Treasurer, Josh Frydenberg, come out and say, well, we'd encourage banks to start lending again when the market started getting a little bit tough. So it's also worth keeping in mind that if you were in a downturn or things got serious in the property market, that the government can indicate to banks that they'll go a little bit easier on your responsible lending obligations, depending on what that environment is.
Yeah, you've both got quite economic brains, and I'm really interested to know like what the actual feeling on the ground is and what the projections on the ground are for that economy that obviously dictates lending conditions, dictates property prices. Because I hear all sorts of things. So I hear that the market's rallying post-election now that everyone knows that negative gearing is here to stay and no government's ever going to be game enough to touch CGT again and all of those things. Equally, I hear that the banks are really tightening their purse strings. Then I hear that first home buyers are racing into the market. And there's all sorts of credible data to back up all of these completely conflicting arguments. I mean, you have to make decisions based on the market. You actually have to put your money where your mouth is with your clients and, you know, with the properties that you're dealing with. So what is the economic environment to you from where you stand?
Really, really, really tough question. If you had to step back
I know,
and
no one can answer it.
To take a 100-foot view, you'd say that everything hinges on the US trade war with China because our economy is just so intrinsically tied up.
Really?
With
That's
that.
not a faraway thing.
I don't think it's a faraway thing at all. I think it's a here thing. I think if you look at a few things that really support our balance of payments, it's things like iron ore exports, coal exports, LNG exports. As soon as Vale start producing more iron ore, then that iron ore price will come off and royalties, et cetera, will switch around. If you want to get a little bit closer to home and say, well, is the local fish and chip shop going to survive? Then that's going to become a function of, well, you know, we'll see a little bit coming out of the iron ore royalties or China coming off, but it becomes a confidence game. And there was a really good piece of data that came out. I don't really want to plug the bank, but which bank, right? Which looked at a bunch of Google trends and Google analysis to look at some forward purchasing decisions. And their analysis is saying we may have bottomed. So perhaps there won't be another cut from the RBA. Things are turning around. Are there first homeowners racing to the – I don't know about that. I think there's definitely been some more positivity. I'm not sure about people racing out though.
Okay. I need to ask you a question about Trump, but we're going to need an ad break for me to recover from that first. So we'll be right back. Thanks. Welcome back. And here we are to talk about Trump. Now, I write quite significantly across our financial services titles here, and obviously anything to do with trade wars, as you just mentioned, really impact the equities portfolios that we discuss on some of our wealth titles, and they have a material impact on the value of those assets that people are trading domestically and internationally. All of those factors that you just mentioned, Simon, how do they actually impact a property price? And do they?
Sure. What are the fundamentals that drive property prices? Well, it's leverage and the price of leverage, which is the cash rate or the spread over cash primarily. And can you access that leverage easily? You saw post-GFC where credit became very tight. Things came off, and it was probably more obvious in the United States than it was here, but it certainly got tighter here. We saw something similar post-Royal Commission here, very, very soft, but still occurred. Now, if we saw a significant, there's no real room, rather, for the RBA to loosen much more in terms of monetary policy. And if we start seeing people lose jobs, then people can't pay mortgages. People can't pay rent. So it's not just the mortgage. It's can you pay your rent? Are you going to Myer and shopping? And the big concern is the indebtedness of the nation. We're at 141% debt to income ratio, which is, unlike most countries, the government has very little debt. It's all been transferred to the household here. So would a macro shift where people lose some jobs here, it would have a more than proportionate impact than some other economies.
Got it. Okay. So you look at all of these trends now, the vacancy rates that we spoke about at the outset, these economic factors that we're talking about now, confidence that maybe does or maybe doesn't exist. And you're making decisions, the two of you, based on this environment with a projection of like 20, 30 years, right? So to you, Cameron, what's a blue chip property in 30 years? Like, what's a property that you're picking now that's going to hold its value for another generation?
Yeah, so I think that there has definitely been a big shift that's happened over the last couple of years as a result of some of the issues in terms of oversupply around apartments. I think people have understood that there's a real premium on land, that having a property that's perhaps in a brand new apartment block with high strata fees is not necessarily the best investment compared to, say, having a standalone property that's on a good street and that is likely to be able to house a full family or even some empty nesters on a little bit of the smaller side. So I think that there's definitely a premium on land and that's something that we're going to see more and more of. We're seeing things like house and land packages becoming popular again, something that perhaps hasn't been the case in the last couple of years. And also things like townhouses as well, as the average family downsizes and you have baby boomers coming through looking to retire.
Yeah.
I think that there's a real market there.
Yeah. I've probably in a way even overcomplicated it, haven't I? Because the kind of properties that you're talking about are really just going to be the ones in short supply.
Yes.
It's pretty simple supply and demand, isn't
Yes.
it? Especially medium density in Sydney. It just doesn't really exist anymore.
No, it doesn't. It's becoming harder and harder, and I think that the more medium dense properties are sort of going further and further out from the CBD. You see things like Parramatta, for example. They've spoken for a long time around that becoming a second CBD. We might get a second airport at Badgerys Creek. It's been approved, but it's been there for 50 years.
Yes.
So all these other areas where there's going to be infrastructure and you have land, I think has got good investment potential.
Yeah, don't even get me started on Badgerys Creek, please. As someone who grew up in and around the southern suburbs and was born in the 80s, that has been a blueprint for a very, very long time. It's actually outrageous.
It is.
It is actually outrageous. And as much as that's a little bit of a joke, that's actually something to consider, isn't it? I personally, being from New South Wales, and sorry, Gladys, I don't believe in infrastructure investment until I see the ground being dug up. Is that fair? Am I paranoid?
No, I think it's totally fair. I live very close to the light rail project and a
my condolences.
Yeah, and a stadium that's now been knocked down with no one to rebuild it. So I think that's a totally fair comment.
Yeah, okay. Goodness, I've framed everything as just diabolical, haven't I? But obviously you two are in business because there is opportunity in the market. Obviously, you just have to be really wary. Have you got any advice for anyone who's listening in who I've terrified about where a good buy would be? Or just what to look out for, really?
I think it's like everything. You go in with both eyes open. Do your due diligence. Spend time, research. No one is putting a gun to your head to say buy.
No.
And you're not going to miss out on anything.
No, not in Sydney. You're not. There's plenty.
And not anywhere though. If sometimes spending an extra couple of days researching is going to save you, maybe a decade's worth of savings or lost income or so on and so forth. So it's worth doing your research. Economies bounce back. Economies turn on a dime. We're in a situation where we've not necessarily been before, but it doesn't mean be bold, but it doesn't necessarily mean be fearful either. It means be prudent. And if you can look at an investment opportunity and it stands on its own and you've done the numbers and, I hate using the word spruikers, but you've not been sold something, you've actually done the research, you're going to do okay. Whether that's property or shares or whatever it is. Maybe you don't buy shares today because they may be overvalued, but maybe you don't buy property for the same reason, but you wait and you do your research because the opportunity will come up, but it won't come to you. You've got to find it.
Okay, no, that's fair. You think so too, Cameron?
Yeah, my advice would be to focus on cash flows. No one ever goes broke receiving enough money from their property that they could pay their mortgage. Where people do go broke is if, they end up in a situation where they're focusing purely on the capital gains, and then you end up in a situation where, say, negative gearing gets removed or you lose your job. It's a much more high-risk property strategy. If you focus on what cash flows are coming in and doing everything that you can to actually maximise those cash flows, sure, you may not end up with the world's biggest property portfolio, but that you'll still have it in 20 years' time.
Let's go back in time to a world where possibly a Labor government would have come in. What do you reckon removing negative gearing would have done to the property market?
Well,
it's a contentious one.
Yeah, well, I guess there are two parts to this. There's what it would have done to the property market, and then there's the broader issue of whether or not it would have been a good thing in terms of the economy to remove some of those tax breaks. And that's a conversation for politicians. But I think what we...
And for Simon.
Yes, and for Simon, yes.
I'm chomping at the bit to have a turn.
No, that's why I'm turning to Cameron for this one.
But I think what you saw is you saw that people were so desperate for $1,080 that the ATO couldn't process tax returns for the first 2 weeks.
It's upsetting, isn't it?
Yeah, you had 50,000 people submit on July 1st their tax return. And if you imagine, first of all, that money not flowing through, and then you had a situation where, in fact, from here on in, property owners would have been seeing even less of their money coming back through the tax system. And then when they sell their property, that they end up losing half of the capital gains discount. Well, I think you might have seen a situation that wouldn't have been too unfamiliar to the last Labor lot, Kevin Rudd.
Mm-hmm. Simon? Keep it G-rated?
I think if the way the proposal was mooted was probably right. I think if they kept capital gains, and at some point the negative gearing argument will come up again. There's no doubt. We do not have a broad enough tax base at the moment to support our ageing population. Now, we either reduce the pension or we reduce a significant tax break, which happens to be the same people that receive it, that baby boomer generation, in the majority.
Love the boomers.
Love the boomers. free universe. Anyway, but not to bash one generation. But when we look at negative gearing, perhaps, and we'll go back to why it was originated, which was to support economic growth. And there's a lot of economic growth from building new assets. So keep it on that. Keep it on building new homes. Keep it on building and developing new lots, because that adds to the economy. It adds to that multiplier effect that we all love and talk about as economists, as opposed to when we look at keeping it on existing properties, perhaps it's not as positive from that point of view. But I think at some point in the next 5 years, the conversation will be had again by no matter which government or which party's in power, just because of the burden that the pension system is going to be under.
Yeah, okay, that's a pretty fair assessment. I guess the reason that we wanted to speak to you about all of these things is that property, and for most property investors, it really is buy and hold. It really is. I'm going to hold on to this for 10, 20, 30 years. So it is important to take a look around and think, what's the big picture here? The property that I'm buying now, is it going to fit for the market that I want to sell it in later on? If I want to downsize, maybe if I want to add more, if I want to leverage my equity, these are really important factors to consider. But again and again with property, it seems to be that the most sound strategy is always have enough money to do it, buy a quality property. I mean, is that a pretty fair assessment? And you just need to be really aware of these market factors to make sure that you are getting to that point.
That's absolutely fair. But also on top of that, if you're smart and just do some research.
And smart. Please be
smart. And smart.
Yeah.
Maybe streetwise is better than smart.
This is smart property investment, not streetwise property investment.
But looking at something like where and we talk about off the plan, and we've spoken about new department development.
I'm trying to stay away from that, Simon.
Some of them are good, but some of them are bad. But that's okay. If you can sift through that, there are still discounts to be had because some of that negative media has flown through. And so you sort of sit there and say, well, maybe that's something we do, each to their own. But sometimes you can take advantage of some of that negative story and some of those negative media to take a position.
Yeah, of course.
And I think Simon was making a good point earlier that you can talk as much about the economy. There'll always be economic headwinds. We go back to even when times were good prior to the GFC, you had interest rates at 7.5%. And people were going broke from their huge mortgage repayments as their house was increasing in value. But so there's always going to be an issue. But I think if you look at property over a long period of time, over 15, 20, 30 years, there's almost never been a period where in real terms property's really gone backwards. Does it mean that you're going to get 10% growth like you've had in previous decades? No, not necessarily. But I think it's also important to separate what happens to asset prices and what happens to the underlying economy. If you look at the share market, for example, in the US, when you've got a positive jobs figure, the share market actually goes down because it means that there might not be cheap money. So even if you end up in a situation where the economy is struggling a little bit, well, we've seen that the end result of that has been lower interest rates, which hasn't necessarily been bad for property investors.
Thank you both for your wonderful advice. Appreciate your time.
Thank you.
Thanks, Kat.
Thanks for tuning in, everyone. If you like what you heard today, don't forget to leave us a rating, and you can also follow us on Facebook, Twitter and LinkedIn. This has been Smart Property Investment Show. We'll catch you next time.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.